Money FM 89.3, best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got a largely lackluster session last night. We did see the S&P 500 rise modestly. That helps extend a strong start to the week that now pushes the benchmark into the green for the year. So the broad market index up by 0.1% to 5,893. The Nasdaq Composite did better, gaining 0.7%. But the Dow Jones Industrial Average underwater yet again, 0.2% down to 42,051. Overall, tech stocks seem to do well, among them Nvidia advancing more than 4%. So lots to unpack here. Helping us out is Steve Sosnick. He is the Chief Strategist from Interactive Brokers. Steve, thanks for joining us. How are you doing these days?
I'm doing great, Ryan. Good morning to you.
Good morning as well to you, Steve, and of course, good evening to your part of the world. Lots to unpack here as we figure out what's going on. First, the tariff environment, as well as the volatility that's been a big part of the year. What have been your biggest takeaways so far?
Well, I think we've had this huge sentiment change from broadly positive to horribly negative and now back to quite positive. When we came into the year, everybody was all excited because they were expecting a return of a president who favored the markets and looked at stock markets as a way of showing that he was doing a good job economically. And the markets were hopeful for deregulation and a more market-friendly president and easier regulation. And we got neither originally, right? We really have had very little talk about deregulation. And his first move out of the box was tariffs, which no one in the market wanted. There was, of course, domestic policy, but that was to cut down immigration, which is actually not particularly market-friendly either because it shrinks the labor force. And then in the initial response to the tariffs, it was sort of like, I don't really care. Markets are going to do what they're going to do, which really freaked people out. Then I think he remembered what he needed to be doing. And the market sentiment turned around very rapidly. And now I think you have a situation where people are so enthused and so momentum driven that they're willing to say, oh, you know what? 145 was terrible, way worse than what we had before. I'm talking about the tariffs vis-a-vis China. 30%, that seems pretty good. Let's step back and say 30% tariffs in the U.S. on anything coming in from China is really inflationary. But that the sentiment got so bad that 30% seems good when you were thinking about over 100%. It's a little, we're really flipping from one extreme to the other.
That's right. So a bit of an inflection point of sorts for markets. We had a lot of tariffs and now a lot of deal making. Of course, the U.S. making a deal with the UK, and now with China, with a bit of a compromise of sorts, the can being kicked down the road. And then in the Middle East, where it's making more deals. So it seems like there's more reason for markets to go up rather than down right now.
Well, that's certainly the case, and that's why we were able to close at a bit of a higher level today, despite the fact that the S&P 500, was essentially unchanged all day. What got us into positive territory was yet another round of deal making. It's pretty clear that the president has taken his most favored companies along on the ride with them, and he's working on deals on their behalf, whether it's Boeing, whether it's Nvidia. I think they made a big spectacle of driving around in a fleet of Cybertrucks today. So Tesla certainly got its little shout out. So, and that's not a surprise because those were the companies that did the best today. Meanwhile, the healthcare stocks are suffering because on the one hand, it's pretty good that he wants to talk about cutting drug prices. Now, to be fair, drug prices were cut by Biden. Trump took away the cuts and the same sort of thing. And then the cut, he wants to put in similar cuts to what Biden has. And the market, of course, is flipping from one extreme to the other. But he likes making deals. It's very clear that this is what he wants to be doing. But now the question is, have we gotten to such a point where the sentiment has flipped so far that it might be a little too bullish? Or have we gotten so in love with trend following and the momentum that's in the market that maybe we need a little bit of a breather? Today was a little bit of that breather. And I think that was some of what we were dealing with today. A bunch of people called me and said it seemed so boring after some of the crazy moves that we've had. And I guess consider after moving 3% one day and 1% another day, zero, it seems dull.
Yeah, it does seem that way. So a bit of a tug of war between momentum and fundamentals. And you've come up with a bit of a term called socially acceptable volatility. And I think that kind of sums it up very well, how this is the new normal of sorts.
Yeah, I mean, this is a term I've kicked around for a while, and I think it's very appropriate now. And the way I show it is normally just a graph of, market going down 2% one day and then 2% up the next day. And, plain old volatility is the down move. Socially acceptable volatility is the up move. From a mathematical point of view, from an options trading point of view, which is my background, volatility works in both directions. But yet we think of volatility increasing when markets go down. And to be fair, volatility does tend to be higher in down markets than it is in up markets. But what we've seen recently is volatility, again, you referenced at the top of the segment that, we're back in positive territory for the year. And, that includes essentially a 20% down move in between. So that is a lot of volatility on the upside as well. It's very unusual to get that kind of move upward unless you're talking about Fed cutting rates or, coming out of a real depressed market situation, which to some extent we had, although it was, I would argue, a bit self-inflicted. What we're seeing now is socially acceptable volatility. The volatility has still been eye-watering. Think of how many weeks and months we went without 1% moves or even 2% moves. Now we're sort of like, hey, 3%, that's pretty cool. Instead of what is going on, that's so that's so outlandish. So that's where I like to call it socially acceptable volatility. We like this volatility. People like it. Markets are supposed to go up, and they do over time. And certainly the reason we invest is we hope they go up, and that's why it's socially acceptable as opposed to just plain old volatility.
Yeah, Steve, does that require a new way of approaching markets in the sense that you need to hedge against the volatility by maybe looking at options?
I think so. And it's interesting because the simplest way to measure the volatility expectations of the marketplace is the SIBO VIX index. It's not perfect. We could spend an hour segment on that, and I won't bore the listeners with that. But one of the things I also like to say is, VIX is not a fear gauge, but it plays one in the media. We think of it as the fear gauge. Because VIX, again, as I mentioned, volatility, people fear volatility when it goes down, but they don't mind it when it goes up. So we saw during the extreme downward moves, we saw VIX get as high as like 65 or something. Now, there's a little trick that traders use, and the volatility is expressed in annualized terms, which doesn't really help for an index that measures the volatility, meant to measure the market's expectations for volatility over the coming 30 days. So the little trick is when you see an implied volatility number, it's usually expressed annually, divide that by 16. It has to do with the number of the square root of the business days in a year, which is coincidentally very close to 16. So you take a VIX right now, which is about 18, and that's saying the market is expecting moves plus or minus 1%. And it's usually not exactly that. And remember, it's high to low within any given day. When it was at 65, we were talking about expecting almost 4% daily volatilities. That's of course, virtually impossible to sustain. So we do go to extremes. And that's why I think right now, when we see VIX back in the mid-teens, which is around the levels it was when the market was, let's call it in its happy place before, I think that's a reasonably good way to start hedging. One of the tactics I would say is don't fight the tape, because you don't really want to be shorting into this market, but maybe you should insure against it. And it was very expensive to buy that insurance when VIX was very high. It's really not that expensive to buy it when VIX is, in the high to mid-teens.
Right, great tip on how to manage the volatility in the markets and approach investing right now. We've been in conversation with Steve Sosnick. He is the Chief Strategist for Interactive Brokers. Steve, thanks for your time and insights today. Great chatting with you.
My pleasure, Ryan. I hope we talk again soon.
Yep.
Take care.
Looking forward to that. Catch up with you again soon. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.